Welcome to our essential guide on short-term lump sum investing. Today we'll focus on how to keep your money safe and liquid while still earning a smart return for goals within the next 12 to 24 months. First, we'll frame the safety first principle. Then, we'll compare the top cash vehicles, show decision diagrams, and finish with clear, actionable steps. Let's get started. Here's our roadmap. We'll start with why safety and liquidity are essential for short timelines. Next, we'll unpack the 1 to 2 year rule. Then we'll examine the 3 best safe havens: high-yield savings accounts, money market accounts, and money market mutual funds. After that, we'll highlight costly pitfalls and how to avoid them, touch on a quick debt payoff framework, and then give you a step-by-step setup guide. Finally, we'll check your understanding with a quick quiz. Let's move forward. If your funds are needed within 1 to 2 years, safety and liquidity dominate the decision. There simply isn't enough time to recover from market volatility. The objective shifts from growth to preserving principal, while maximizing yield in cash-like vehicles. In short timelines, the expected extra return from risk assets usually does not justify the risk of loss. Now let's formalize this with the 1 to 2 year rule. The 1 to 2 year rule states that when your timeline is under 2 years, protecting your principal and ensuring easy access outrank chasing returns. You can and should still seek a competitive yield, but only within cash-like, low-volatility instruments. In this context, equities are not appropriate for funds earmarked for a specific near-term goal, because even minor volatility can jeopardize your objective. With that principle set, let's explore the top 3 safe havens. There are 3 primary vehicles for short-term cash. First, high-yield savings accounts offer FDIC insurance, immediate liquidity, and competitive APYs that can exceed 4%. Second, money market accounts are bank products similar to HYSAs, sometimes with check-writing privileges, and are also typically FDIC-insured. Third, money market mutual funds available at brokerages invest in short-term government debt, which is very stable but not FDIC-insured. They sometimes yield slightly more than bank accounts. Next, we'll look at each in more detail. High-yield savings accounts are usually the easiest and safest option. They are FDIC-insured up to applicable limits, provide straightforward access, and often come with competitive promotional bonuses. APYs can exceed 4% depending on the rate environment. Transfers within the same bank are generally instant, and external ACH transfers typically take 1 to 3 business days. This makes HYSAs ideal for emergency funds and short-term, goal-based savings, such as down payments or tuition due soon. Now let's consider money market accounts. Money market accounts are bank accounts similar to high-yield savings, but sometimes provide check writing or debit access. They are usually FDIC-insured when held at an insured institution and offer yields comparable to HYSAs. If you want the ability to write a check directly from your savings vehicle, an MMA can be practical. With that covered, let's examine money market mutual funds. Money market mutual funds are offered at major brokerages and invest in ultra-short-term government or agency debt, such as treasury bills. While they are not FDIC-insured, they have historically been very stable and frequently offer yields competitive with, or slightly higher than, bank-based savings products. To maximize your net return, focus on funds with low expense ratios and reputable sponsors. Next, we'll compare bank accounts versus brokerage money markets at a glance. On the bank side, HYSAs and MMAs typically provide FDIC insurance up to applicable limits, very simple setup, and strong liquidity, with internal transfers often instant. They offer competitive yields, though they may lag the top money market mutual funds at times. On the brokerage side, MMFs are not FDIC insured, but invest in high-quality, ultra-short government instruments, and can offer slightly higher yields. Internal transfers within a brokerage are straightforward, and some funds settle same day or next day. Your choice depends on your risk tolerance around FDIC insurance, your preferred platform, and yield differences. Next, let's visualize a decision map. This mind map lays out the key factors: your time horizon, safety via FDIC insurance and stability, liquidity features such as instant access and settlement times, and the main options: HYSA, MMA, and MMF. It also highlights pitfalls, like leaving money in low-yield checking or exposing funds to market volatility. The action items are to open a competitive account, move your funds, and consider automating sweeps so idle cash doesn't accumulate in low-yield accounts. Next, we'll quantify differences in a simple table. This table summarizes each vehicle. HYSAs and MMAs are typically FDIC-insured up to applicable limits and yield around 4% or more, with straightforward access through bank apps and ACH transfers. MMFs, while not FDIC-insured, invest in very short-term, high-quality instruments and can provide competitive or slightly higher yields, depending on fees and market conditions. Access often settles same day or next day at brokerages, but confirms specifics.
Now let's walk through a practical, step-by-step setup.
Follow these steps to implement quickly. First, confirm your exact timeline to avoid unnecessary risk. Second, check your FDIC insurance across banks to ensure coverage. Third, compare current high-yield savings or money market account rates and promotional bonuses, and shortlist 2 or 3. If you prefer a brokerage, compare MMF yields and expense ratios. Next, open the chosen accounts and link your funding sources. Then transfer your lump sum and verify availability and settlement. Automate monthly sweeps from check into your high-yield vehicle and set quarterly reminders to review rates and promotions.
Coming up, a common pitfall to avoid.
A major mistake is leaving substantial cash in low or zero-yield checking accounts. The opportunity cost can be hundreds of dollars per month for six-figure balances. Even taking a few minutes to move funds into a high-yield vehicle can materially increase your passive income.
Now let's address a controversial but important point about debt.
Before parking your cash, evaluate whether you have high-interest debt. Eliminating high-interest debt provides a mathematically guaranteed return that often beats the variable yield of a savings vehicle. However, if the cash is absolutely required for a near-term purchase, prioritize safety and liquidity first. Otherwise, compare the after-tax risk-free return of paying off debt to the expected yield in your chosen cash instrument.
Next, let's test your understanding with a quick quiz.
Quiz time. You need a down payment in 12 months. Which is most appropriate for the bulk of your funds? The options are A, individual stocks, B, high-yield savings account or money market account, C, a long-term bond fund, and D, cryptocurrency. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. With a 12-month horizon, you should prioritize safety and liquidity. High-yield savings accounts or money market accounts are purpose-built for this. Stocks, long-term bonds, and crypto can be too volatile for a fixed near-term goal.
Now let's try one more question.
Here's the second question. Which statement is most accurate about money market mutual funds? The options are A, they are FDIC-insured, just like bank savings. B, they invest in ultra-short government debt but are not FDIC-insured. C, they lock your money for 12 months. And D, they always yield less than checking accounts. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video.
The correct answer is B. Money market mutual funds are generally very stable and liquid because they invest in ultra-short government or agency securities, but they are not FDIC-insured. Bank accounts like HYSAs and MMAs are the FDIC-insured options. Next, we'll reinforce key points with a quick visual breakdown.
Here's an example allocation. 60% to a top high-yield savings account, 20% to a money market account, and 20% to a money market mutual fund. This is purely illustrative. You can use just one excellent option or split across a few for convenience and redundancy. Be mindful of FDIC insurance limits and the friction of moving funds. Review rates quarterly and rebalance if yields or needs change. Now, let's add a planning diagram for timelines. This Gantt diagram will show a practical timeline. Initial setup in the first 1 to 2 weeks, ongoing rate monitoring and maintenance for months 1 through 12, and a consolidation period as you approach the purchase date between months 12 and 24. Milestones include quarterly rate checks and a move-to-bank milestone around 30 days before your goal.
This visual helps you plan actions well ahead of the target date.
Next, we'll include a quick decision flow to solidify the process. This flowchart turns the principles into a simple decision. If your horizon is under 24 months, decide whether you need check writing. If you do, a money market account is logical. If not, decide whether you prefer FDIC insurance. If you do, choose a high-yield savings account. If you don't, a money market mutual fund may be appropriate. In all cases, automate sweeps and set rate review reminders.
Before we wrap, let's include a brief disclaimer.
Disclaimer: this content is for educational purposes only and does not constitute financial, legal, or tax advice. Your situation is unique. Before making decisions, conduct your own research and consider consulting a qualified professional. Now, let's capture the key points and close out. These are the core takeaways. If your goal is within 1 to 2 years, prioritize safety and liquidity. The top vehicles are high-yield savings accounts, money market accounts, and money market mutual funds. Avoid leaving large balances in low-yield checking accounts. If the funds are not earmarked for a near-term purchase, consider paying down high-interest debt, which provides a guaranteed return. Finally, automate your cash management and review rates quarterly. Next, we'll summarize the entire video. In summary, apply the 1 to 2 year rule to short-term goals, protect principal and keep access easy. Choose from HYSA, MMA, and MMF to maximize safe yield. Automate sweeps and review rates regularly so your money keeps working.
As you approach the goal date, consolidate into the most liquid option.
Finally, let's close with a friendly ask. Thanks for watching. If this video helped you protect and optimize your short-term cash, please like the video, share it with someone planning a big purchase, and subscribe for more practical money guides. Tell us in the comments whether you prefer HYSA, MMA, or MMF and why. See you in the next one.